Hey everyone, me Kevin here. Well folks, the truth is out on GameStop and the events that unfolded in January. It is apparent now that what happened in January was not a short squeeze on GameStop. It was a short sneeze. And in this video, we're going to talk about how powerful the ape army really is and how it's actually way stronger than anyone expected. And this SEC report that I just spent over an hour and a half going through word for word, I actually did most of it live on the channel, you could see it, is mind-blowing. In this video, I'm going to give you the highlights. Let's get into this because this GameStop short sneeze happened on my birthday, January 28th. So it's really special to me. All right, folks, let's get right into this. Number one, the SEC says GameStop is quote, this is their wording, okay? Like somebody's got to frame this or make t-shirts of this, in my opinion, okay? The SEC says GameStop is, quote, the most famous of meme stocks. I love that. Really frame that. All right, number two. And this is going to be, the first couple of these are going to be a little bit of background to help you understand the rest. Best execution for stocks, which we keep hearing brokers talk about, oh, we give you the best execution, does not mean best price. It just means the best speed or best quality or, quite frankly, best whatever's available at the time. So when a broker tells you you got the best execution, it does not necessarily mean you got the best price. Number three, the median account balance for Robinhood account holders is $240, and the average age of a customer is 31 years old. Number four, 1/6 of the accounts made through Apex Clearing, through companies like Webull, have an average age of just 19 years old. In other words, not the accounts have the age, but the people who have those accounts. So 1/6 of all the users using Apex Clearing, again, websites like Webull, have an average age of just 19. Number five, market makers can either make trades through public exchanges, which is public information, or internally, which is off-market, through what are sometimes called dark pools, but more technically known as internalized trades or consolidated trades. Number six, according to the SEC, a combination of factors led GameStop to skyrocket. And this you should write down because this is the definition of a momentum movement. One, large price movements. So in other words, you see large movements in price, people are interested. Large volume changes, so quantities in the amount of shares moving, not just the price of a share going up, but a lot of shares trading. Large short interest, number three. Four, frequent Reddit mentions. They even mentioned YouTube potentially. Five, significant coverage in mainstream media. Those are the five criteria really for a momentum-based stock. Kind of neat to write those down. So again, large price moves, large volume changes, large short interest, frequent Reddit or YouTube mentions, and significant coverage in mainstream media. Number seven, until recently, GameStop was one of the only stocks that had its short interest go up over 90% since 2007 and 2008. They did also state that it is normal for stocks to potentially go over 100% short interest when people re-lend shares that they then short. That is okay, they said. Well, I mean, they didn't explicitly say it was okay. They just said this is how it happens. And by not really saying it's not okay, they're kind of saying, yeah, like it could happen. It's just really, really rare. Number eight, yes, hedge funds did in some part, at least certain hedge funds, like quantitative hedge funds and trading hedge funds, did actually participate in buying shares of GameStop to make profit off the trade. So there were hedge funds that were actually competing with retail investors, which makes sense. And there were hedge funds that did likely, according to the SEC, buy shares of GameStop to cover their shorts. However, the SEC did not find that drops in short interest actually led to large price increases alone. Though the drops in short interest contributed, the SEC says that large price movements really came from more people just buying shares and hodling them. So in other words, not the squeeze. Basically putting to bed that the idea of GameStop's price going up was caused by a short squeeze. There was short covering, but we didn't really see a short squeeze. It was a lot of retail buying and hodling that led to this, which is really important for what ended up causing all of this to fail. We'll get to that in just a moment. Which I think this is a really good part to mention that if you like my perspective, consider checking out the programs linked down below on stocks and the psychology of money. You get all of my buy-sell alerts, whether it's for crypto or for stocks or for options. Check that out down below. It is the Stocks and Psychology of Money program. And there are also programs on building your wealth through real estate investing, property management, real estate agent sales, you name it. Check it out down below. There's a coupon code 41% off that you can use. That price does go up in 11 days. So check that link out down below. Number 9, instead of a short squeeze, we likely had continued buying pressure occurring from social media because everybody wanted to maintain a short squeeze. So even though a short squeeze wasn't happening, we all felt united in trying to maintain a short squeeze, and this led the army of retail investors, us, to continue to buy and hodl. It was the reason to keep fighting, and we did, leading the price to continue to go up. Now, what about a gamma squeeze? Well, remember, a gamma squeeze is when hedge funds or institutions buy shares to delta hedge call options that are going in the money. If that was really foreign to you, don't worry about it. It basically means when people are buying YOLO call options that actually start becoming profitable, institutions might have to buy shares to hedge those call options. So, don't worry if that still doesn't make sense. Basically, the more things go to the moon, the more things go to the moon. The SEC found that a gamma squeeze was not a reason GameStop went to the moon. They said that options trading actually peaked around January 27th, which was the day before we saw GameStop actually go to the moon of about $484. And they said that this increase in peak options trading was actually driven by put purchases. So market makers were actually buying call options with the apes rather than buying shares to hedge all the puts. Crazy. But they did mention that between January 22nd and January 27th, we saw a lot of people actually getting out of options, like getting out of call options, and we saw put volume increase more. So people were increasing their bets against GameStop by the 27th and 28th, which means the odds of a gamma squeeze wouldn't really make sense because the opposite was actually happening in the market at the time. Crazy. So no short squeeze, no gamma squeeze. Dark pools? Yes. But what about naked shorting? Well, this is when you short a stock that you don't own and you have no intention of actually finding somebody to borrow the shares for. You just basically short it without actually owning the shares or knowing somebody where you could borrow them from. It's evil, it's complicated, it is based on trust and being able to clean it all up after the fact. And the SEC's determination here was no. That naked short selling was not a big cause of price action in GameStop. That most failed to delivereds, which can happen on longs and shorts, making it kind of difficult to determine if there are short failed to delivereds or long failed to delivereds. But either way, most failed to delivereds cleared within a day, and there were no, quote, no persistent failed to delivereds. So wait a minute. If there was no short squeeze, no gamma squeeze, no naked shorting, why did the stock go up that much? Simple, folks. People kept buying it, and they bought it, and they held it, squeezing liquidity. This led to significant off-exchange trading via dark pools, which likely led to poor pricing for consumers and wide spreads and big profits for the market makers. It also, again, reiterating this, it led to extremely low liquidity. Remember, if you're on the public market, generally more liquidity, transparent pricing. Dark pools, not transparent pricing. Wide bid-ask spreads, lots of pauses and halts on the trading stock. That's a sign of low liquidity. In fact, these automated pauses aren't the suits trying to screw us, although maybe that's what they programmed them for, I don't. They're really intended, whether we believe it or not, they're really intended to pause the market to allow people to put in more buy-sell orders so we have more liquidity in the market and so the market could try to function normally again. But because everyone was hodling, this wasn't working, leading to a lot of pauses and the price continuing to go up. Remember, folks, the definition of momentum. Large price moves, check. Large volume changes, check. Large short interest, note, not short squeeze, just large interest, short interest, giving people a reason to participate in the trade, right? Frequent Reddit and YouTube mentions and significant coverage in mainstream media. We had all of these things. So, what killed momentum? Well, it was none other than the pausing of trading, specifically from companies like Robinhood, who blamed the NSCC for bankrupting margin requirements that would have basically demanded so much money from Robinhood that they would have potentially gone bankrupt. But ultimately, the SEC found that it was up to the brokers to pause or restrict trading. It was ultimately the broker's responsibility. They did not have to pause or restrict trading. If they could have come up with the margin requirements for the NSCC, which in fairness, Robinhood was able to, within 48 hours, potentially as soon as 24 hours, come up with the money they needed. So in theory, trading didn't have to get restricted, but we hear from Robinhood that this was a 5 Sigma event and that their hands were tied because of retirement requirements from the NSCC, which, in fairness to the NSCC, because everybody wants to blame them, the NSCC actually waived penalties during this time, because otherwise brokers would have had to have come up with even more money. So it's almost like the NSCC is like, yeah, this is crazy. We're going to try to be as nice as possible here. Maybe everybody's at fault. Who knows? The way the system was set up was designed to clearly screw the retail here. But anyway, now, this is interesting. Because of essentially all this high volatility and these wave penalties, but still companies like Citadel taking 55% of all the internalized trades during the peak of this GameStop crisis, and Virtu taking 26% of all these trades, there are rumors and speculation that companies like Citadel and Virtu ended up colluding with companies and brokers, and this is just a rumor, could totally be wrong and not factual at all, and there are even lawsuits around this, that potentially Robinhood and Citadel and Virtu, these companies colluded to say, hey, look, our buddies like Melvin Capital are losing their pants on shorts, they're getting burned, can we just restrict trading and try to let this momentum die really fast? Nobody knows. I guess we'll find out more in lawsuits. Obviously, that is the suspicion right now. Again, the SEC found it was ultimately up to the brokers as long as they were capitalized well enough. And this has obviously led to the argument that, well, Robinhood should have had more money. But again, Robinhood's argument is like, we could have never planned for this. But then again, they were able to raise the cash really quick. So who knows? So at the bottom line of the report, the SEC recommended less gamification, which kind of feels like a slam on Robinhood, and more short interest reporting and transparency on dark pools. This was a staff report, so it doesn't actually say anything about what the SEC is going to do. They're just sort of trying to outline what the heck happened. And so, folks, there you have it. What happened? Retail investors got a nail in the coffin shoved into them on January 28th, screwed from continuing the movement, and then everybody jumped ship. So think about it. We were like a big old Trojan horse, and we were ramming the castle really hard. But all of a sudden, somebody came around and took our battering ram out of our Trojan horse. I guess it wouldn't really be a Trojan horse if it's a battering ram, but I think you get the picture. And all of a sudden, we're like, oh, well, we can't really do anything anymore. Okay, let's leave. And everybody jumped ship. And, the stock crater's like 80%. Now, obviously, GameStop is recovered. But, yeah, folks, the SEC here saying, not a squeeze. Dark pools exist. We've got no gamma squeeze. Not a real issue with naked shorting. But instead, we had a massive momentum movement that got crushed by brokers. There you have it, folks. If you find my insights helpful, consider checking out those programs linked down below on building your wealth, and subscribe to the channel. Share the video if you liked it. We'll see you in the next one. Thanks so much, folks. Goodbye.